fix and flip loans for beginners. All right, guys, today we're going to talk about fix and flip loans for beginners, whether you're just getting started, haven't done a deal yet, or have been thinking about it for quite some time. And we're going to talk about why today, right now, is the time to get started with these fix and flip loans. So let's talk about it first off. So the idea here is you find a property that is in need of repairs. What most people don't realize is a traditional bank, a big financial institution, we'll make this a big, these guys will not loan money on a property that you can't move into. It's got to be move-in ready. Why is that? Because the bank takes on additional risk if there's a bunch of repairs that have to be done to the property. Because if somebody buys this property and the plumbing has an issue and the furnace stops working and all that stuff, the homeowner that buys this is going to have to spend money fixing those things, which could make it hard for them to make their payment to the bank. So what the banks do is they hire an appraiser, and the appraiser goes through, and typically if he's looking for FHA condition, he wants to make sure that everything's in working order. He also wants to make sure that the life expectancy of most of the stuff is 5+ years. So like might need to have a 5-year roof certificate, those types of things. But the appraiser is going to go through the property, and if he sees anything that's concerning, he's going to call it out, and the bank's going to say that has got to get fixed by the seller or we're not going to do this deal. Well, some things are fairly easy for the seller to fix, like the slope has to be going away from the house, not towards the house. When you're talking about the slopage towards versus away, the shingles have to make sure you have a 5-year roof certificate. But what if there's a whole bunch of problems with this property? What if the driveway's cracked? What if the kitchen's been torn out? What if there's been a leak in the basement? What if the roof needs to be replaced? Well, then this bank is going to say, no, we don't want to do that loan, because what's going to happen is someone's going to come in here, they're going to get hit with a big $30,000 bill, and they're not going to be able to pay us, and they're not going to be able to pay that, and we're going to have to foreclose on them. So banks want to make sure that they're in move-in ready conditions. So what happens to these properties? Well, if someone owns a property that needs that work, okay, they have two options. Number one, they can pay and get the work done themselves, right? So they can come out with money, $30,000, fix the property up and do all that. Now, typically, if they had the $30,000, they probably would have been doing the work along the way, and the property wouldn't have gotten into this type of condition. So this is usually not an option, right? Like, well, if I had the money, then I would have done it along the way. So the second thing they can do is they can sell to someone that is a cash / hard money / private finance buyer. So this is what you need to realize. Everybody says, I'll make a cash offer, I'll make a cash offer, I'll make a cash offer. Very, very, very rarely does somebody make a cash offer. What they typically do is get private or hard money to come in and fund that. But sellers like the idea of cash, so people say cash. So technically the definition of cash is it's money that's in your bank account. Okay? This bank says, hey, yes, he has $350,000. Perfect, gives it to there, and you're buying it with cash. But what happens is most investors say, I'll pay cash for your house, because at the end of the day, once the closing happens, it's all cash to the seller, right? It's all cash to the seller. So it really doesn't make any difference whether they're getting financing or using their own cash. To the seller, they're getting cash. So that's one of the things that a lot of people get confused with. So I like to put cash / hard money. The difference between hard money and private money is usually from a person, unreliable, you don't know what they're going to do or not do and all that type of fun stuff, whereas hard money typically comes from more of an established company. It's kind of the difference there. Now, if you've got this house and it needs this work done to it, you've got to pay to get the work done, or you need to sell to somebody that can come in and buy that property and get the work done. Now, if somebody's going to do that, they're going to be taking on risk, okay? The risk that they're going to be taking on is market changes. Is the value going to go up? Is the value going to go up? Is the value going to go down? So what's going to happen with those over the next 3 to 6 months? Who knows? It could go up, it could go down. You don't really know, and things can change drastically when you think about wars being started or market conditions or interest rates going up. Like a lot of stuff could affect that. I don't think it's huge risk, but it's something to keep in mind. The other thing that you can be looking at is the risks with the repairs. You may think you're only going to spend $30,000, but once you tear some sheetrock out, you might find something you didn't expect and have to spend more money on plumbing, electrical, or whatever the case is. So that $30,000 could then turn into $40,000, right? So there's risk in this. And that's why somebody that is buying a property as an investor has to get a good deal. So an investor that's doing this needs to be able to have the purchase to buy the property. They got the money to buy. They're going to have closing costs to buy. They're going to have loan fees / interest. This is going to be like title fees and that type of stuff. So they're going to have to pay for that. They're going to have to pay for the repairs and maybe some unknown repairs. They're going to need to factor in some market change or some negotiating room. And then they want to make a profit. One of the things I tell a lot of homeowners when I'm going directly to homeowners is, hey, what do you think is a fair profit for me to take the risk on to buy this property? And surprisingly, lots of times they thought I should make a lot more money than I was proposing. Because typically my goal was to make at least 10%. So if you think about all of these costs, and I can tell the seller, well, here's my market change. I'm going to plan on 5%, and I'm going to plan on 10% of unknown repairs, whatever the repairs is. So that's going to be $3,000. Say this is $30,000, and then my loan fees. Let's say interest is 10, or maybe even 15,000, depending upon how long I've got it out. One of the things you want to do is look at time on market to help you determine that. Closing costs. What's the title fees? I usually plan on 1%. And the purchase price, whatever I buy it for. So what I do is I reverse engineer it. I say, okay, well, if I can sell the property for this amount, let's say I can sell it for $350, okay, and I've got to make a profit and market conditions and unknown repairs and that means I can't pay any more than this for the property, right? That's how that works. So I work with a seller and I put that together and get the property under contract. This is how the whole process works. Now, why is now the time to get started with these fix and flip loans? Well, actually, we probably should talk a little bit about loans for a minute. What is a fix and flip loan? A fix and flip comes in to do, let's do that. What is a fix and flip and why now? So we talked about the bank, and the bank isn't wanting to do that. So it's going to be hard money / private money. So what does hard money / private money do? Well, they lend based upon the asset, which is the house, rather than the ability to repay. So for example, when you go to a bank, okay, and they are going to want to know your FICO, they're going to want to know judgments, they're going to want to know collections, they're going to want to see your pay stubs, they're going to want to see your bank accounts, they're going to want to talk to your employer. They're going to want to make sure you've been on the job for at least 2 years. They're going to want to make sure that you're stable, like all this stuff. They want to make sure that it's W-2 income and that it's not self-employed income, all those different types of things the bank's going to want to do and tons more, right? I'm just scratching the surface. Because what a traditional bank or mortgage broker or whatever the case is looking at is they're saying, what is this guy's ability to repay the loan based upon his track record? So how has he paid his prior bills? What's he been doing with his pay stubs? Does he make enough money? Is there enough ratio there? Those types of debt to income ratio, all those things is what the bank's looking at. Well, the hard money lender isn't looking at those things at all. Now, they're going to want to make sure that you don't have judgments or collections or foreclosure, but they're not going to care about your bank, your pay stubs or your ability to repay or any of that type of stuff, because they're going to look at ability to repay based upon the value of the property. So if you're buying this property for $150,000 and it would be worth $250,000 by putting $30,000 in repairs in it, then that has enough value for them to be lending. So they're lending on the value or the future value of the property, also known as the after repaired value of the property. Now, how can a private hard money lender do this? Well, the way they do it is this money for the repairs is part of their collateral. Okay, so this money for the repairs, they hold that and do draws on that to make sure all that money goes into the property. Because if it doesn't go into the property, they're going to have to use that money to go into the property in order for them to hit the value that that property needs to be. They also need to make sure the condition of the repairs are done the way that it needs to be done as well. Okay, so that's kind of the difference between your bank and your hard money or your private money. So you don't have to have experience. You don't have to have good credit. You don't have to have a great job. You don't have to have 2 years of income. You don't, like, none of those things matter. What a hard money lender is going to want to make sure is you don't have a bunch of collections, because those collections can attach to the property. They want to make sure you don't have judgments, because those judgments can attach to the property. They're going to want to make sure that you're not in the middle of bankruptcy, but beyond those things, collections, judgments, bankruptcy, or, if you're recently got foreclosed on, like, those are like the big things they're looking for. Hey, if you don't have these things, then you can get a hard money loan. However, they may look at FICO score to price the loan. Okay, so the better your FICO score, the lower you will pay in fees and costs and interest. The worse your FICO score, the more that you'll pay. But it's not the question of, can I get a loan or I can't get a loan? Yes, you can get a loan as long as you don't have these big things. It's what are you going to end up paying for that loan? And that's going to come down to what you pay for that hard money loan. Is going to come down to your experience. It's going to come down to the amount of money you're bringing down or contributing to the deal. It's also going to come down to your FICO scores. It's going to come down to loan to value. And it's also going to come down to purchase price. What are you getting it for? As well as what's going on in the market, days on market, those types of things. The bank wouldn't even give a loan on this property because the condition of the property is not in such condition that somebody can move in and start living there. And so they say, nope, we can't do that loan. So basically what somebody's doing when you're a beginner doing fix and flip, and getting a loan to do that, is you're taking a house that's not marketable, because a traditional bank or brokerage firm is not going to be able to do a loan on that because of the condition of the property. You are putting it into the condition so that they are then able to, which now makes that property marketable. So now somebody can go in and get a bank loan to purchase that property. So that's the whole idea of this fix and flip loan. So next, let's talk a little bit about why now is the time, why you should be looking at doing this today in this marketplace. Here's the deal. I believe that the right time to plant a tree was yesterday, and the second best time to plant a tree is today. Too many people are waiting for the perfect timing, the perfect market, the perfect everything. And I'll tell you, it just doesn't come. And when it does come, you don't even recognize that you're in the perfect time. I'll give you an example of this. Back in 2008, we had been seeing values go down, problems. We've seen properties getting foreclosed on, all kinds of crazy stuff. And honestly, we should have bought every property we saw. But the values had gone down so much, we were worried they would continue to go down so much. We didn't have confidence that values would even stay where they were. We thought they were going to go down again tremendously, and they did continue to go down. They didn't go down in half again. But we were concerned about that, so we were reluctant. We did buy some properties, but we were reluctant to buy a bunch of properties. Now, in hindsight, right now, you say, you should have bought every single property. Yes, yeah. But when you're in the middle of it and you just saw your net worth and your values get cut in half, that's very difficult to have that same mentality. So, why now? As a real estate investor, I don't care if you're a beginner, experienced, or whatever the case is, you're always going to be solving for one or two situations, okay? So remember the old teeter-totter when you were in high school, when you were in elementary school, maybe is better. So we got this little teeter-totter, right? We got the grass and all that stuff. Okay, so if one side's up, the other side's down. The other side's up, the other side's down, right? It has this inverse relationship. Well, here's what we have an inverse relationship with as real estate investors, okay? Properties are either easy to find, and then they're hard to sell. or they're hard to find, and then they're easy to sell. Okay? You're always going to be dealing with one of these. What does this mean? It means if it's easy to find properties, then I'm going to be able to get properties under contract, and I am going to be able to do that with some ease. Okay? But I'm going to have a harder time selling that. Why is this? Well, it becomes to a buyer's or a seller's market, right? If properties are easy to find, it's a buyer's market. If they're hard to sell, then it is a buyer's market, right? If they're easy to sell, then it is a seller's market. And if they're hard to find, it is a seller's market. What does this mean? If they're hard to find, it means the seller has the advantage, which means I'm going to make a ton of offers and I'm going to have to chase properties. I'm going to have to work really hard to do that. But once I find something, it'll be fairly easy for me to sell that property because a lot of people want it. The buyers are going crazy. Well, the opposite is if I'm having an easy time to find properties, I'm going to have a more difficult time to sell properties. So if you want to be a successful real estate investor, you have to know how to make money in both sides of this equation. Regardless of where the market is, you need to realize how to do that. Now, part of that is your strategy. What is your strategy? What are you trying to do here? Well, there's a few ways that you can do some of these real estate deals. One, you can do what's called a bird. Okay, when we talk about fix and flip, you can fix it and you can flip it into getting a loan rather than flipping it to sell to someone else. You can also fix and flip, where you actually flip it to a new end buyer. And you can also look at just doing a wholesale deal where you get short-term financing in order for you to sell that deal to someone else. So these are some different strategies that can be used based upon the market that we're in, based upon if it's a buyer's market or based upon if it is a seller's market. Okay, so why do I say now is the time? Number one, it is a buyer's market. Okay, so what that means is it's going to be easier to find, but it's going to be harder to sell. What most people don't realize is we have a housing shortage. Unlike during 2008, when we actually had an oversupply of homes, we have an undersupply of homes right now. What that's doing is because interest rates are continuing to go up and are going to probably somewhere stay around this range for a little while, it is fighting off inflation, but it's also demotivating people to sell their house and move up. For example, maybe you're a family with a couple of kids and living in a condo in a 2-bedroom, and you're just so sick of living in that 2-bedroom because you really want a 3rd bedroom, but you have an interest rate of 3%. And if you went out and bought something new, your interest rate would be 7.5%. So even though you would have done that, your payment would go up when you bought a bigger house, but now it's going up. Plus you're going up for the extra interest rate. And so they're saying, you know what, we're going to wait until we see things change before we go make that change. Think of an older couple that may be saying, we are so tired of taking care of the lawn. We're going to sell this house. We're going to get out of this house and we're going to go to something smaller, a move down type buyer. Well, same problem, less affected because I'm moving from something more expensive to something less expensive. But again, if I'm moving from a 3% interest rate to an 8% interest rate, I'm going to say, maybe I'll just wait. And that's the thing that we're seeing here is there's a limited supply of houses that are on the market. That's the big thing that's here. And the reason for that is because we don't have enough supply and because we have people that are not buying and selling like they normally would due to the interest rates. Well, so why is the Federal Reserve doing all of this? Well, they're doing this to fight off inflation. We've been seeing the cost of goods, price of milk keeps going up and going up. And so the Federal Reserve says, hey, this market's getting too hot. We're going to need to regulate it, which the way they do that is they increase interest rates, which is the interest rate that the bank borrow from the Federal Reserve at, which for a long time has been 0. So they increase that interest rate to try and slow those things down to have what they call a soft landing. So that's what we're looking at now. But one of the reasons why I say, hey, now is the best time to be getting a fix and flip loan if you are a beginner is because it is a buyer's market. So what you got to realize here is if you buy a property and you can get financing on it, and there's a thing called DSCR, debt service coverage ratio, which you don't have to have tax returns and all that type of stuff. It's just based upon the debt service that the property income can cover the debt, okay, on the property with taxes and insurance and all that type of stuff. So what you can actually do is you can buy a property, okay, you can fix up the property, and then you can refinance it, kind of like your flip, but instead of flipping it to a new buyer, you're actually refinancing it and flipping it to a long-term loan. Okay, so here's the idea. If you can buy the property and get a good deal on the property, because it's more of a buyer's market, and then you can refinance the property and turn it into a rental property, then when interest rates come down, which they will, I don't know if that's next week, next year, 10 years from now, but when interest rates go from 8% down to 3%, which I have seen in my real estate investing career, when they do that, then you refinance and you double your income on that rental property. Okay, so I want to make sure that you understand how this all plays out. What has to happen is you've got to buy a property that's a good deal. You spend the money, you get a hard money loan, and you fix that property up. Before you do that, you get approved for a loan with a debt service coverage ratio, which basically means that your income from the property needs to equal how much the mortgage payment will be, the taxes, the insurance, and all that type of stuff. And if they're 100% or 125%, meaning if it's $12,500 in income and you have $10,000 worth of expenses between taxes, insurance, and those things, then you're at a 125% debt service coverage ratio, which means you have 25% more than what your expenses are. 100% would be 10,000 on 10,000. That'd be a 100% debt service coverage ratio. The secret to all of this is you've got to make sure that you're breaking even on your monthly payment versus your rent. So as long as your rent with all of your costs equal what your payment's going to be, you're buying a good deal because you're buying it at a low period of the market and you're buying it at a high interest rate. So once those interest rates come down, you can refinance and make quite a bit more money. So what we're basically saying is your rent, let's say the rent on that property is $1,000 a month. So it ends up being $12,000 for the year, okay? And let's say that your expenses are, $10,000. That means there's $2,000 left over. I would even say if you can get 100%, if you spend $12,000 and you make nothing every single month because you're at this high interest rate, that's a good deal, okay? You want to make sure that you can take money out for taxes and insurance, and you need to have a little money for capital improvements and for some repairs. You also need to plan on some vacancy. So what I like to do is plan on 5% for capital and 5% for repairs, 5% for vacancy and taxes and insurance. I have this property taxes. I've got a pretty good idea. Now with all of that, if I can be at zero, which might put me, more to that 120%, because I need some money to do these things, because 5, 10, 15 would put me like 115%. If you can do that with today's interest rates, you're buying a great deal. Now, it's going to take time. That's the thing that most people don't realize, and why they don't get in, why beginners aren't getting fix and flip loans in order for them to do these, is because they're thinking too short term. There are multiple ways that you make money from rental properties, okay? So you make money from rent, also known as cash flow. Well, in this scenario that we're talking about, we're not going to make any money with that, okay? So the next way that we make money is rent increase. If you look at rents over time, they have gone like this for the same median property, okay? So rent increase is something that's more of a long term. The other thing you'll have is price increase. The value of the property is going to go up. Same thing. Even if you look at 2008, it was a little blip in the radar, and you're going to see the same thing, that over time, you're going to see the value of the property continuing to go up. The other thing you're going to do is the debt pay down. Most people don't realize this. Every single month that the tenant pays their $1,000 or whatever that rent is, and you pay the $900 to the bank, guess what? Part of that payment is paying down the principal balance. So let's say $200 that goes to principal and $700 that goes towards interest. Okay, so what happens is your tenant is paying down your principal loan balance, and if they did that every month for 30 years, they would pay for the loan even if you weren't making any money. They are paying down, which actually is making money because they're paying down that loan for you. A lot of people don't understand how an amortization schedule works. So we'll talk about that here in just a minute. Okay, so the other thing you have is you have the tax write-offs. Okay, so you will be able to write off some interest expense, or you're going to be able to write off taxes, property taxes, or whatever the case is. Get with your CPA, and then you're going to have what are called business expenses. And this is one of the most overlooked. So your cell phone, you can now pay for with pre-tax dollars rather than after-tax dollars, because you're going to have a cell phone. You're going to be able to reimburse yourself for mileage. Because you're going to need to be able to get to the property and maintain the property. You're going to be able to pay for your computer because you're going to need your computer to do the business work, but you're going to do that with pre-tax dollars rather than after-tax dollars. What does that mean? It means when I buy this, I am not going to be paying income tax on the money I use to buy that computer or the money I use to buy that gas. Now, obviously, you've got to get with your CPA, but when you look at these things, there is a big money savings here. There's a big money savings here. There's a money long-term play here, and you will see the values of the rents and the property values going up over time. As a matter of fact, I want to show you what happens to these values over time. This is from 1940. So in 1940, the average monthly rent was $27. That same house in 2021 was $1,191. And what did I do differently? Nothing. I just kept the property up. I took care of routine repairs, and it went from $27 to $1,200 basically. That's huge. Let's just look over 30 years. So let's say that you bought a property in 1990, okay? 1990, you bought a property, average rent was $339. Now the average rent is $1,200. So it takes work, it takes time when it comes to your success as a real estate investor.